Hi, everybody. Sorry for the small delay with little technical difficulties, but we're on and ready to go. So good afternoon and welcome. We're so glad that you're here with us today. Thanks for joining King Wealth Planning and JP Morgan Asset Management today for an educational presentation. My name is Elizabeth McComb. I'm the business manager here at King Wealth Planning. And we've also got Paul King and Shannon Corpus, our financial advisors, with us. We've got a great presentation in store for you today. We hope you find this information timely, interesting, and valuable. We're happy to be collaborating with JP Morgan to discuss the market outlook for 2025, trends and analysis, and other important information. So we're very happy to have Meera Pandit from JP Morgan with us today. We're having difficulty with camera, but her voice, you will hear her. You won't see her, but you'll hear her. Here's just a little bit of a background on Meera. She's an executive director and global market strategist on the JP Morgan Global Market Insights strategy team. She's been with the firm since 2011. She's responsible for delivering timely market and economic insights to institutional and retail clients, conducting research on the global economy and capital markets, and running economic forecasts. She's also responsible for publications such as The Guide to the Markets and is a contributor to the JP Morgan Long-Term Capital Market Assumptions. Meera is also a frequent guest on Bloomberg, Yahoo Finance, CNBC, CNN, and other financial news outlets, and is often quoted in the financial news. So clearly, she's the perfect person to deliver our topic today. So before I hand the mic over for the presentation, I have just a few housekeeping items to go over. Everybody's muted today so we can keep our sound quality good. We'll be recording the webinar and it will be available on our website, kingwealth.com, shortly after we close. So if you'd like to get back and listen to it again or share it with somebody else who may have missed it, you can find it there. Also, we'll address any questions that you have at the end of the session. So as we're going along, if you come up with any questions, please email them to me at kwp@kingwealth.com. I'll pick those up and we'll address them at the end of the session. So that's all the housekeeping. I'm going to turn it over to Shannon now to get us started.
Hi, everyone. Thanks so much for joining us today. I am getting over this terrible, terrible cough, and I just popped in a throat lozenge, so please forgive me if I have something in my mouth. I don't want to be coughing on you. Okay, well, Meera has some great insight to offer you today, so pat yourself on the back for taking advantage of this opportunity. I wanted to emphasize one slide today. Paul, can you move to the Moments That Matter slide? Yeah, I want to emphasize this for you today because life is a journey, isn't it? And along the way, there's several key financial milestones of which you need to be aware. And these are, yes, you guessed it, the moments that matter. And this timeline shows those pivotal moments, and each one is a chance to make smart financial choices. And these can have a big impact down the road for your financial life and your strategy. So as you and your family move through these stages that you're seeing on the slide, we'll tap you on the shoulder and say, hi, this is an important time to take a look at your finances. You've got this coming up. And so whether it's hitting an age milestone, starting to plan for retirement, or navigating Social Security and Medicare, we'll make it easy for you. And we'll send you educational resources to keep you informed. We'll talk through your questions and weigh out options with you, collaborate with your CPA and or your state attorney, and even connect you with experts from our partner network if necessary. The idea is that you'll face these changes feeling confident because you know that you've got a plan that grows and evolves with you and the stage of life that you and your family are at. And we get it, these milestones can feel overwhelming, and that's why we're here to help you, to guide you and your loved ones. So know that your financial well-being is always our top priority. And this graphic, such a cool little graphic, and it's just a small reflection of the kind of support that you get from us. And with that, I will hand it over to Paul.
Thanks, Shannon. Welcome, everyone. Yeah, these moments that matter, you know, we, as Shannon said, we'll tap you on the shoulder, but if you have relatives, sons and daughters, anyone, even if they're not a client, if you can give us their contact information, that's what we do, is track these birth dates, and we'll reach out to them, get them some good information. So, yeah, last year was a great year for investors. Mostly, you know, the stocks and bond markets were good. Alternative investments, it's quite a broad category, so some good, some not so good. And real estate, again, you know, both a little bit spotty, depending on the types of properties that you had. But overall, a great year. But we spent a lot of the year, you know, advising clients on much more beyond the investing side. Quite a number of clients transitioning, selling homes and moving into retirement communities. Of course, helping with tax consequences of various things that we do. Insurance analysis is a big part. So, you know, if you have older policies or long-term care policies, we can review those and make sure they're up to what you need, or other strategies of what to do with money inside, you know, older policies. So just know that we're out there. We can help facilitate conversations with your attorneys, tax advisors. We like to collaborate with other professionals that way. So always feel free to reach out to us for any other considerations besides the investment side. But turning to our presentation today, JP Morgan puts out a what they call Guide to the Markets every quarter and updates that. And if you're a data geek like me, we can do a deep dive. There's probably over 80 pages and slides of data. Pretty amazing, and they're well known for it. So Mira's going to not go through 80 pages. She's broken down some of those key concepts. And we all know that, you know, elections have consequences, and everybody's wondering what's the consequences to my portfolio based on the new administration and all the change in government. And of course, the Federal Reserve plays a big role in how the economy is rolling along. So with that, I will turn it over to Mira and let her give us some of JP Morgan's insights and guidance.
Great, thank you so much for having me. Appreciate the opportunity to share our outlook for 2025. And when we were thinking about moving from 2024 to 2025, we still see a lot of the very robust fundamentals for the economy that we did last year. Economic growth looks sound, the labor market looks healthy, inflation's a little bit stubborn and a little bit sticky where it is now, but we are still expected to see extremely strong profit growth of about 15% over the course of this year. So what changes from 2024 to 2025? For us, the big change is around policy, not just the new administration coming in and some of the policies that come off the back of that, but also monetary policy, because we have our Federal Reserve, our central bank, potentially causing some uncertainty as to the path of rates this year, even though just a couple of months ago it looked like 2025 was done and dusted in terms of how monetary policy would play out. So we think about 2024 to 2025 as a fundamentally solid economic backdrop with some policy curveballs potentially, both from the government and from monetary policy. So if we take a look at the next slide and first start with the strong economic backdrop. What we can see on this slide here is economic growth on a year-over-year basis, and we look at the contributors to real GDP over time. Sorry, I'm getting a little feedback. There we go. What we see on this slide here is economic growth over time, and you look at the contributors to overall real GDP growth. Now, what we have seen over the last several quarters is above trend economic growth. In fact, essentially for 8 out of the last 9 quarters, we've had above trend growth, and we are on track for yet another one to come. And that is because all of the major actors in the economy continue to fire on all cylinders. You have the consumers, you have the government, you have businesses. So if we start with consumption in that light blue category there, about 68% of the overall economy comes from consumption. And in each and every quarter on this slide, it continues to be a big driver. Consumers continue to spend, although the composition of that spending has changed. It went from lower to middle income consumers spending on goods, services, everything people can get their hands on, to more upper income individuals doing more of the spending on services, and across the board a bit more judiciousness in terms of what people are buying. Nonetheless, consumption in aggregate remains strong. If we look at that green category in lime, government spending, the government continues to spend, and we could notch another $2 trillion deficit over the course of 2025. State and local governments have spent quite a bit as well. Then, if we think about the gray bars there, businesses continue to take advantage of subsidies like the CHIPS Act and the IRA Act and put massive capital forth towards things like AI. And this is really heartening because rates are at reasonably high levels. So financing is expensive, and yet businesses continue to invest for the future. So consumers, government, businesses, everyone continuing to spend. While we don't necessarily expect that spending to occur at the breakneck pace it has more recently, we do expect it to still be reasonably solid and allow growth to moderate back to trend. Now, if we think about that 68% of the economy coming from consumption, if the labor market is strong, that should support overall consumption. So if we take a look at the next slide, what this slide shows in gray is the unemployment rate over time at about 4.1% today. Not only is the unemployment rate reasonably low, especially if you look across the decades on this slide shown, but also it's been stably low, pretty consistent here. In fact, the last 3 years we've had at or around 4% unemployment. So people broadly have access to jobs. Not only that, but if you look at wage growth on a year-over-year basis in blue, while it has come down, it's plateauing at a pretty high level, again, if you look over the last couple of decades. Now, critically, wages have grown faster than inflation for the last 20 months in a row. So in aggregate, people are earning faster than their costs are going up. That, plus the low unemployment rate combined, has led to some pretty reasonable consumption because the worker is the consumer is the worker, and with these fundamentals intact, it does tend to support the economy overall. Now, the bugbear of the economy, despite strong growth, strong labor market, is really around inflation. So if we take a look at the next slide, inflation has made tremendous progress towards our 2% target, but it is kind of getting stuck where we are today. So one, I want to call out the fact that while the idea of inflation being in a reasonable place sounds ridiculous, inflation and price level are different. Prices continue to be high, and they are not going back to what they were pre-pandemic, but inflation, which measures the increase in prices, has slowed pretty considerably. You can see in this slide here when we had over 9% inflation in June 2022 and how that has come down to just under 3%. It's not quite where we want it, but again, it has made a lot of progress, not only in terms of the pace of inflation, but also the composition. Because underneath the surface, if you looked back to June 2022, or really any time in 2021, 2022, you had this nice rainbow mountain of sources of inflation. Energy, food, goods, services, shelter, kind of coming from everywhere. And yet, if you look at where we are today, inflation is much more narrow in terms of contributors. Now, a lot of those contributors are pretty similar to the makeup of inflation back in 2018, 2019. You have services, you have shelter, and you have the oddly potent and persistent category of auto insurance. Now, we do expect these areas to continue to very gradually dissipate, but it is certainly a gradual process and could take the rest of the year and, in fact, into the next year to really get closer and closer to that 2% target. It's sort of like for anyone who's set a weight loss resolution for the new year, or indeed has already abandoned it. If you think about those last couple of pounds, those are always the hardest to shed, and that's really where we are with inflation. A lot of progress, still some progress to go, but we're in that last mile.
Mira, I have a question
Sure.
regarding inflation. So we always talk about U.S. inflation. Other major developed countries, are they seeing that same sort of sticky trend? With global economies, like, is that, part of the sticking point for our own inflation?
It's a bit of a mixed bag. You can see areas like Europe seeing some progress on inflation, but the UK is still experiencing sticky inflation. You actually see China in deflation, so they're having trouble supporting prices. For a long time, that was Japan's problem, but actually Japan is seeing probably a healthy amount of inflation for their economy. So at this point, it's less synchronous than it was, where everybody had low inflation, then everybody had a high inflation. Now it's a little bit more mixed across the board. But I think that a lot of the areas where things are a little bit stuck are common in terms of core inflation. So if you take out commodity prices, essentially, because even in Europe, where you had a big commodity price spike, even more so than in the U.S., while that is reversed out, there's still some inflation related to higher wages, for example. But what we're seeing, is if you think about the central bank, the Federal Reserve in the U.S., where their calculus has been a little bit different than other global central banks is, even though inflation has become tame in other regions, growth is pretty weak. And so their cutting cycles abroad are somewhat predicated more on weaker growth than inflation being under control. Whereas in the U.S., we continue to have somewhat stubborn inflation, but also very strong growth. And that is what has differentiated the U.S. from many other parts of the world. But the predicament that the Federal Reserve is in is essentially, if you look at this slide here at inflation, this is yesterday's inflation. And the Fed is fighting yesterday's inflation with today's data under the specter of higher inflation tomorrow. And that higher inflation tomorrow could come from tariffs. If we potentially do see some degree of tariffs come online, about 17% of consumer spending is imported goods. So that would potentially raise the cost of goods. It would potentially raise the cost to companies as well when they're putting things together. So there could be a bit of an expansion in this orange category that has actually been deflationary as of more recently. So that does put the Fed in a bit of a tricky spot as they think about plotting out the course for monetary policy in the year ahead. So if we take a look at the next slide, this slide looks at the federal funds rate over time in gray. We can see where we are today at about 4.38%. And essentially, the Fed has cut rates by about 1%. And back in September, when they started cutting rates, they intended to, or at least projected, that they would cut 4 times in 2025, 4 quarter-point cuts for a total of another 1%. Come December, they revised that expectation lower to about 2 cuts in 2025. And they really focused on the inflation aspect of the picture, as opposed to putting a premium on the fact that growth has been strong. Because think about what the policy rate does for us. It is the rate at which we neither stimulate nor restrict the economy. And clearly right now, rates with strong growth and somewhat stubborn inflation are not restrictive for the economy. So they really don't have to cut that much. I think they could have as simply said that, but I think that they did stoke some fears around inflation, unfortunately. So where do we go from here? If you look at the blue line, that does look at expectations by year end for the federal funds rate by the end of 2025, 26, 27, long run. Essentially, the Fed looks for potentially 2 cuts this year, but the market, which reprices every day based on economic data and market ongoings, in green, is right now mostly in line with the Fed for 2 cuts this year, but that expectation has changed rapidly throughout just the last 28 days. So over the course of this month, we had a hot jobs print, and all of a sudden the market was only pricing in 1 cut for the year. Then we had a softer inflation print, and the market started to price in 2 cuts again. So this number has moved around quite a bit. Hard to say exactly what the Fed does this year, and they will be paying attention to ongoing developments just as we are. But I think that, the big factor here is, one, we're probably in a high for longer environment, which means that we're not going to see a massive drop in interest rates in the absence of a recession. And two, we're likely to continue to experience market volatility as the Fed itself tries to figure out what exactly their path is going forward. So what does that mean for fixed income investors? It means we have to reorient the way we think about bonds a little bit. Because if you take a look at the next slide, this slide looks at the 10-year Treasury yield in blue, minus inflation is that gray line, but essentially we've seen a pretty rapid rise in rates more recently. So the Fed has cut 1% and basically rates have risen 1% over the same time period. That is highly unusual. So if we reorient ourselves in terms of why we own fixed income and what benefits it provides, from the financial crisis through COVID, we didn't get a whole lot of income from fixed income. But we did get pretty good downside protection, and stocks and bonds moved in opposite directions, so we had some nice diversification. Now we're in the environment where income is actually ample. If the Fed's not going to cut much more, that means we should continue to get some pretty good yield from our bonds. However, if we're a little bit uncertain about the path of rates here, that means rates could remain volatile, and that protection and diversification from appreciation fixed income could potentially be a bit more volatile and less reliable. Now, one of the other factors in terms of why yields have risen is it's not just about seeing stronger growth, stronger inflation, but the fiscal policy and debt and deficit starts to play a role in this as well. So we take a look at the next slide. This slide looks at the state of our federal finances. What we can see on this slide here is our budget on the left, and then on the right-hand side, we see the debt and deficit. And actually, if I could just remind everyone quickly, just to remain on mute, I'm getting a little bit of feedback, so I'm not sure if that's picking up. There are some concerns. No worries. There's some concerns about debt and deficits that have been pushing up yield. Essentially, the longer end of the yield curve, think about a 10-year Treasury bond or a 20-year or a 30-year, not only are they governed by stronger inflation and stronger growth, but also our federal finances. So what we can see on the left is spending of potentially $7 trillion in 2025 and a deficit financing of nearly $2 trillion. So there's a lot of calls from the new administration, how do we cut some of this back? The realities of cutting spending massively from a government perspective are really challenging. And the way we built the chart on the left is looking at things that you have to spend on and things where you could potentially cut. So essentially, you have to pay your interest payments. Social Security, Medicare, Medicaid, those have been areas that potentially you could see cuts from the perspective of what the administration has said, but in reality, it's pretty challenging politically. So you likely won't see much there, even though there have been some headlines about that. Other mandatory spending in gray is like things like veterans benefits, probably not going to see a big cutback from there. And then finally at the top there in purple and in orange, you see defense and non-defense discretionary spending. You could potentially trim a little bit from defense, although that doesn't seem to be this administration's position. So it's really around non-defense discretionary spending. Again, not a huge amount we can really do there, given that that is still some of our essential services. So you can see how all of a sudden the idea of cutting $1 trillion or $2 trillion in a short amount of time becomes difficult. The other lever you can pull if you're not necessarily cutting spending is to up your revenues. Tariffs has been one area that has been floated, and you can see on the right-hand side, tariffs make up about $80 billion of our revenues. That's tiny when you think about the rest of the revenue sources there. Even if we exponentially raise tariffs, it would still take some time to really start to make a dent here. There's a governing body called the Committee for Responsible Federal Budget. They're essentially sort of a think tank, and they estimate that tariffs, as they have been proposed, could raise about $2.7 trillion over the next decade. So that's only about $300 billion each year, and that again doesn't put a huge dent in the overall deficit financing. income taxes is the biggest source of revenue. And essentially, if we see an extension of the Tax Cuts and Jobs Act, that is going to bring that amount down over the next 5 years. So what you're left with on the top right is our deficit on an inverted scale. You can see that the higher the deficit here, the higher the bar. And just what's in law right now has put us at about 6.4%. That is about double the 50-year average of where the deficit usually is. And if you add on an extension of the Tax Cuts and Jobs Act, that will make things even a bit more expensive there. So you can see that some of the practicalities of reducing the deficit and reducing our debt is actually pretty difficult when it comes to cutting spending and raising more revenue. That is part of the reason why you have seen yields come up a little bit higher, because holders of government bonds think, why should I, or I should be compensated a bit more for holding U.S. government debt if the federal finances are not in the best working order. Now let's switch gears a little bit on the next slide to the equity side. And just again, if everyone can make sure they're on mute. On this slide here, we look at the amazing performance we have seen of the Magnificent Seven stocks in the S&P 500, those big large cap tech companies, relative to the rest of the stocks in the index in blue. You can see that the Mag 7 have performed amazingly well, but yesterday was a good reminder that concentration risk and high valuations do create some risk for portfolios in terms of feeling some of the down days. What you can see is that actually the Mag 7 are gradually relinquishing some of their dominance in terms of returns, making up about 63% of the returns in 2023, 55% in 2024, and year to date, obviously this number is moving around a lot, but about 19% year to date. And actually, after yesterday, it was negative contribution there. That could potentially change after it's closed today, given the market's rebound.
Mira, the big news was around that DeepSeek, and I don't know if everybody's aware of it, but do you have any comments around that? What caused that sell-off?
Sure. So essentially what we saw coming out of this weekend is a very competitive AI technology coming out of China that basically trained its models at a fraction of the cost using older chips, not the advanced ones that many of us have access to, that actually China has some essentially export, the U.S. has export bans to go to China. So they don't have access to those. So what was alarming was that some of these big tech companies are spending lots of money to train their AI models. They're spending a lot of money in terms of energy going into powering these models. And then, there was essentially a new, cheaper version that came out abroad. So it does call into question, should these companies be spending so much? Are they getting a good return on their investment? Is all this going to get democratized and commoditized from here? I think the reality is, look, this is the evolution of AI. It's going to start off as a concentrated theme with only a couple of winners, but over time, more entrants will come into the market. And still the most sophisticated versions of AI are often coming from these U.S. companies. So I don't necessarily think that the U.S. has ceded its dominance from a tech perspective. So something to be mindful of, that we do want to take the sell-off with a grain of salt, because I don't think it fundamentally changes some of the prospects for these companies, but rather broadens the landscape to greater beneficiaries. But even irrespective of what had happened yesterday, if you look at the top right chart, we are starting to see earnings growth. So the Magnificent Seven decelerate in green relative to the rest of the index starting to pick up and accelerate in blue. So some of those mixed results we had been getting are now moving towards double digits. That makes the case for making sure that our exposures to stocks are not just the Mag 7 and are much broader. Now, if we take a look at the next slide, I know this has become sort of a dirty word, but I will use the word international. I know that international stocks have not been particularly successful in recent years, but the way I like to think about U.S. versus international is U.S. is the 5-lane highway. Lots of avenues of opportunity, but it is well trafficked. International stocks are kind of like the back road. They can sometimes take you on a long and circuitous route, but there are some gems along the way. So there are certain avenues of opportunity. There's a lot of interesting cousins internationally where you have very similar companies to what you can find in the US in terms of profitability and business models, but overseas they might trade at more attractive valuations because simply they're not domiciled in the US. Now, if we look at last year, 36 of the best performing stocks out of the top 50 in the world came from outside the US. That is a thing to recognize, that it's not all US stocks that are leading the way. And last year was not a fluke. On average, about 33 of the best stocks come from international. Now, if we move forward one slide, this ties into my slide 2 slides ago, but thinking about risks in the market. And again, we felt one yesterday. It wasn't just the risk that, hey, AI is not just going to be concentrated among a couple of names, the story's broadening out. But more than that, it's about valuations and concentration. What you can see on the left chart is the top 10 stocks over time in the S&P 500, now about 46% more expensive than their long-term averages, while the rest of the stocks are still expensive, about 20% more expensive than their long-term averages. Now, the challenge with high valuations is that when valuations are priced to perfection, they are vulnerable to correction. And that is, to some extent, what we saw yesterday. Not only that, but you can feel those corrections much more acutely in portfolios. In the top right chart there, we can see that those top 10 stocks are about 38% of the index. Historically, they had been closer to 27% at their most, and usually kind of in the teens below 20%. So exceeding the heights that we saw during the dot-com bubble as well. That means, again, on the way up, you can feel that more acutely, but also on the way down, you can as well. Now, I do want to make note that, look, some of these big stocks still provide a lot of value for shareholders. If you look at that chart on the bottom, 40% of R&D, 20% of CapEx. So these are the companies that are investing for the future and organic growth. And then a quarter of operating income and free cash flow. So they certainly are, again, delivering on profits. But it's just important to remember the biggest are not always the best. And I mentioned that on the previous slide. If you look at the top 10 performing stocks in 2024, one of them was the Mag 7. 3 of them were tech companies. The other 7 were utilities, energy, and industrial companies. So diversification can really help.
And just a comment there, Mira, is, people follow these Mag 7 stocks and say, I want some more NVIDIA or I want some Apple. And it's like, if you understand your portfolio with an S&P 500 type fund or a large cap fund, you already have a significant weight there. And so we don't want people to add to the volatility of their portfolio by adding an individual stock like that.
Absolutely. Knowing what you own is critical because, to your point, you already have a lot of exposure because of that sector concentration to a lot of these names. So you're benefiting from it, but you don't want to be overexposed and then have days where you're feeling those gyrations in the market too much. Which brings me to my next slide. Volatility is back. You can see that over time, on average, in those red dots, the S&P 500 falls about 14%. But the calendar year returns in gray show that in 34 out of the last 45 years, those calendar years do end up positive. I don't necessarily worry about volatility unless the fundamental backdrop looks fragile. And right now, per my comments earlier, profit growth looks robust, economic growth looks robust, job growth is still looking strong. So with that type of backdrop, volatility is a normal part of the market, and I don't think it portends something worse ahead. But we should get used to the fact that whether it's policy headlines, monetary or government, whether it's AI headlines, we will probably be seeing more volatility this year, but patient investors have often been rewarded. And then finally, I'll end on the next slide here. This slide looks at top to bottom returns of different asset classes within a portfolio. And what you can see cutting down the middle of the slide is an asset allocation bucket that looks at a diversified portfolio containing all of these elements. And what we can see here is that it's really hard to guess what's going to be at the top in any one given year. And even if you're right about that, those same assets are often the bottom the next year. So it's really hard to market time or guess who the market leaders are. Having a nice diversified profile can really help capture returns on the upside and protect on the downside to deliver a smoother ride over time. Remember, there's some scope for upside here if we think about growth, jobs, and profits, but there's also some scope for downside if we think about stickier inflation, monetary policy, valuations, and concentration risk. So trying to thread the needle in these types of environments can be tricky, and that's where diversification can really help. So with that, I will pause there, and I think I have a few minutes to answer a couple of questions.
Thank you, Mira. I'll tell you, I saw another version of this asset allocation type slide with digital assets or crypto assets, which have outperformed like 8 of the last 10 years. And so they're not for everyone, but we will be having a upcoming webinar on that asset class because it's new, it's little understood. So we do want to educate everyone on it as a possibility to add. So Elizabeth, you have some questions for us?
Yeah, I have a couple that have come in for Mira. So let's see. Which sectors are expected to have the strongest earnings growth in 2025?
What you're going to see this year is some broadening out, not just simply some success from technology, although technology will continue to do reasonably well, but also you're going to see areas like industrials, energy, utilities, materials, all kind of come out of their earnings recessions. We do have a slide in our guide to the markets, which is not captured here, that looks at each sector's 2025 quarterly growth rate. And you can see, again, tech's still going to have some pretty good growth rates here. You see a nice pickup in healthcare, actually, from a profits perspective to different double-digit profit growth. Industrials is another area that starts to see a lot of momentum. I mentioned materials. Financials has done well and should continue to do well. What we've essentially dealt with in 2022, 23, and 2024 is a lot of spotty performance and mixed performance in different areas, particularly some of the value areas. In 2025, as we head towards the end of the year, it looks like a more synchronous picture in terms of earnings health.
Yeah, a number of those sectors, there's still a lot of money in the government pipeline for infrastructure spending, which will impact a lot of the ones you mentioned.
All right, another question. What does the current shape of the yield curve suggest about the economic outlook?
Essentially, the shorter end of the yield curve is governed by the Fed, and the longer end of the yield curve reflects growth, inflation, and also federal finances. So if we take a look at the shorter end, you could potentially see yields come down a little bit if the Fed eases on balance. So potentially steeper yield curve as sort of the belly of the curve or the longer end of the curve starts to rise a little bit. I think that some of that will have to do with, a stronger growth, stronger inflation kind of propping up yields. But also, again, some of those fears over deficits have put some upward pressure there. So overall, steeper yield curve. I wouldn't say that we anticipate yields to rise a whole lot in the middle and longer end of the curve, but it's more that they'll just simply be a bit more volatile. I mean, we've seen them come down in the last day or two quite a bit relative to 10 days ago when they were 20, 25 basis higher. So again, we're going to continue to see some of that movement there.
All right, and one last question. I know you touched on this already, but how are interest rates expected to change, and how will that impact fixed income investments?
So I would focus on thinking through finding diversified sources of income. Income should be still pretty strong if the Fed doesn't have that much more room to cut, but diversification becomes a little bit harder. That doesn't mean you shouldn't think about adding a bit of duration to portfolios, but think about what can do well at what point. If there's interest rate volatility, short duration is likely to do well in the shorter term and over the course of this year. But over the longer term, if we see rates come down a bit, that should be an environment where duration does well. Or if we actually see unexpected weakness in the economy, that should be an environment where duration does well. So it might be more of a medium-term investment, but perhaps one with a compelling entry point today. So something to weigh in terms of what you own and why you own and when it could perform.
All right, that's it for the questions, Paul.
All right, thanks a lot. Shannon, you have any last comments?
No, I don't, but thank you, Mara. Appreciate it.
Yeah, thank you so much for having me.
Thank you,
That's
Mara.
always a great partnership. Thank you, Mara. And to everyone else, we'll see you on our next webinar.
Yep, and the recording will be up shortly.
Enjoy.